The government has issued its tax policy papers, and while they may seem dull or heavy, they do give a good insight into the thinking ahead of the budget. So what can we read into them? Well, firstly, they say that a lower VAT rate for hospitality could be applied to bars and restaurants, but not hotels. The government has said £1.5 billion will be set aside for tax cuts, and that the reduced VAT on hospitality would take up to £1 billion of that. But these papers suggest they could separate out cafes, bars and restaurants for a reduced rate, which would cost the Exchequer £675 million, leaving some room for other tax measures. So, what could they be? Well, there still would not be enough left to increase income tax credits and to widen tax bands to offset the effects of inflation, as these papers show that would cost over €1 billion. Gas and electricity are currently subject to a 9% VAT rate. That's due to go back to 13.5% in October, but the cost of extending that would be €198 million to the Exchequer, meaning combined with hospitality, VAT cuts would cost over €1 billion. The government has promised to look at tax incentives to boost house building, but these papers pour cold water on any prospect to cut VAT rates for construction. Under EU rules, such a cut would only be permitted on social policy purposes, which this document states would be challenging to define. Plus, they say builders wouldn't pass on the rate cut to the consumer, and if it was to go back up again in the future, it could lead to a spike in house prices. A tax relief for gyms and sports club membership was mooted by Public Expenditure Minister Jack Chambers in last year's budget, but the tax papers show this is unlikely to happen. They say it would give a financial boost to people already in gyms, but anyone who's encouraged to join a gym simply because of a tax incentive, they say, is unlikely to keep up their regime, meaning it wouldn't do anything to encourage us to do more exercise. You can follow this story on the Irish Independent.